Hello and welcome to the lecture for Unit 3 in Topics in Governmental Financial Analysis, focusing on financial position and changes in financial position. We're going to begin the lecture by first making sure that we're all on the same page as to what financial position is, and then talk about how it's measured, what kinds of information is reported in the financial statements about financial position, and what the key ratios are, looking in particular at ratios related to liquidity and solvency, and also along the way talking about some of the practical considerations, little bits of ins and outs related to the information in the financial statements that you'll be using in order to calculate financial position ratios. So let's begin by talking about what financial position is. GASB's definition is that it is the status of a government's assets, deferred outflows of resources, liabilities, and deferred inflows of resources as of the date of the financial statements. So we're essentially talking here about what a government has at a given point in time in the way of resources to provide services after you have satisfied its liabilities. So it is comparable to what you might consider net worth if you were looking at an individual or equity, if you were looking at net equity, if you were looking at a corporation. And it is primarily measured by net position or fund balance, depending upon the basis of accounting and measurement focus of the financial statements you're looking at. So in the government-wide financial statements, the proprietary fund financial statements, you're looking at net position on an accrual basis, and on a modified accrual basis in the governmental funds, you're talking about fund balance. We will see as we're looking at these ratios that financial position is something that you can examine in both the long term and the short term. So let's begin by looking at the accrual-based information, net position analysis, but what used to be called net asset analysis prior to the reporting of net position instead of net assets. So this is what your typical statement of net position, government-wide financial statements looks like, and the net position section is at the bottom. It is the difference between assets and deferred outflows minus liabilities and deferred inflows, and it is presented in the three components that were covered in the lecture in the first week: net investment in capital assets, restricted by purpose of restriction, and then unrestricted. So looking a little bit more closely at what that section looks like, you have a variety of options for how you want to slice and dice this net position information in order to analyze it. You could look at the primary government as a whole, or you could look at just the governmental activities, or just the business type activities. And then for any one of those columns, you could be looking at total net position, or just unrestricted net position, or what some people might call spendable, although it is not a great term, and in fact in many cases isn't really accurate, because not everything that's in restricted or even the resources that represent unrestricted net position may actually be in a spendable form. So let's look at probably the most common of the net position ratios, which is total net position. We'll look at total rather than one of the components right now, divided by total revenues. So that's the total net position for the primary government. Total revenues, unfortunately, at the government-wide level, there isn't a total revenue number in the statement of activities, so you're left having to add together a whole bunch of individual numbers. You might, depending upon the government you look at, be able to look at the summary information from the statement of activities that is presented in management's discussion and analysis, but in a lot of cases those numbers are going to be truncated at the millions or the thousands level, and so even though you do have a simple single revenue number here, and there's a special item, a revenue special item down below here that you'd want to include as well, you only have it in the tenths of millions. So looking back at that ratio, total net position divided by total revenues, that equals 0.9967. You could multiply it by 100 if you want, if you prefer to talk about your ratios as percentages, so it would be 99.67%. So essentially what we're talking about here is that the total net position of the government is equal to approximately 1 year's worth of revenues. If it were exactly 100%, it would be exactly 1 year's worth of revenues. Now, you could alternatively look at unrestricted net position divided by total revenues. The problem you have there, though, and I think I accidentally said I was looking at the primary government. This is actually the governmental fund, the governmental activities numbers, is that it's not uncommon for the governmental activities for unrestricted net position to be a negative number because they have so many long-term liabilities outstanding for which they raise resources to make payments on those liabilities on an annual basis, and they don't put any money aside. And now, with the implementation of the new pension standards and soon the new OPEB standards, they're adding another sizable liability that is the amount of that obligation above and beyond the assets that have been set aside. So if they weren't already reporting a negative unrestricted net position number, they certainly are now. And frankly, it's very difficult to interpret what that number means. When it's a positive number, you get a sense of the amount of resources you have and how long they might last. But what does it mean that they've got a ratio here of negative 71.8? Does that mean they ran out of resources almost 3/4 of a year ago? I mean, of course, it doesn't mean that. And this is something that the GASB is looking at, especially in the time after the implementation of the pension standards, where so many governments are it's much more the norm now to have a negative unrestricted net position, and in some cases a negative total net position. And looking at this and trying to get a sense of what it means and how users of financial statements will interpret these ratios, and what types of information they will want in order to better understand net position that is in a deficit position. So let's take a look, at the BTAs for this illustrative government in the textbook, because those numbers are positive and a little bit easier to talk about the implications of these ratios. So total net position for the BTAs was a little over 84 million. Easier in the statement of activities to come up with the total revenue numbers for the BTAs. There are usually fewer of them there. You also could probably go look at the proprietary fund financial statements as well, and in the income statement there you would find a single total revenues number. Well, actually no, you'd have to add the total operating and total non-operating, so it's really not much more straightforward. So this ratio then is 559, almost 560%. That's a pretty healthy, pretty robust ratio. It means that they've got well more than 5 times more net position than revenues, and that certainly looks a heck of a lot healthier than just the sort of even match of net position to ratios that we saw for the primary government as a whole. For the governmental activities. Now we can look at unrestricted net position for them. And so looking solely at the resources that are completely, unspoken for and that aren't invested in capital assets, and that's a much smaller number as you would expect it to be. Rather than putting revenues in the denominator, you could look at expenses. There's a single expense number for business type activities in the statement of activities. And that ratio comes out to, it's still quite large because we're looking at total net position, remember, still. So you've got the net value of the capital assets in there, and you've also got a lot of resources that are restricted to being used for particular purposes. So if you look instead at unrestricted net position, which might give you a better sense of the unfettered resources that the government could put to any use, that gives you a ratio of almost 85%. And one of the neat things that I think that doing this ratio with expenses in the denominator lends itself to is that if you take the ratio and multiply it by 365, it tells you essentially how long those resources would last based upon the expenses of the previous year, and in this case it is almost 309 days, so about 10 months into the next fiscal year, if they weren't bringing any more resources in, is how long that unrestricted net position would last. So that those ratios really are because they include capital assets. If you're looking at total net position, because they may include long-term receivables, other types of non-current assets other than capital assets. Even in unrestricted, you're getting a longer-term view of the financial position of the government. Liquidity uses information, in part from the government-wide financial statements, done on an accrual basis, but it's looking, strictly at the ability to raise resources in the very near term, and in particular focusing on cash and things that are practically cash, like money market investments. There are three most common ratios that are used to measure liquidity: the current ratio, the quick ratio, and the days cash on hand ratio, and we'll look at all three of those. So the current ratio is essentially measuring what resources are available to finance obligations over the next year, and it is simply, most simply measured as current assets divided by current liabilities. And if you're lucky enough to be looking at a statement of net position that is in a classified format, so it's already giving you current asset subtotals and current liability subtotals, it makes it a lot easier to perform the analysis. So here, looking at it for the governmental activities, the ratio comes out to 3.05. So they've got 3 times more current assets than they're facing current liabilities as of the date of these financial statements. That's a fairly healthy ratio. They've got 3 times as much near-term resources as they need in order to deal with their existing near-term liabilities, those that are going to come due in the next year. One practical thing that you need to keep in mind is that the current assets may include some liability, some receivables that have portions that aren't going to be collected in the next year. You remember those items that you're seeing are essentially average liquidity. They're in order of their relative liquidity, but there may be a lot of receivables that they can expect will come in the next month or two, and there may be some that may not come in for a year or two. But that the receivables are appearing there sort of as a average liquidity for all receivables combined. Unfortunately, governments are required to disclose if there are portions of their receivable balances that are not expected to be received within 1 year. So this is what a typical receivables note might look like, that takes what is probably a single line for receivables and breaks it out by a variety of different types of receivables. And the way this is presented, they show that amount that is not going to be collected within the next year on a separate line. Alternatively, you might see it presented in a narrative where they explain that there's a certain portion that isn't collected. And the reason why you want to know this is because you probably should leave that portion out, subtract that from the current assets, because it's not going to be available to the government in the next year, and it won't be able to use it to satisfy its current liabilities over the course of the next 12 months. If you want to get an even more conservative measure of liquidity and the government's ability to raise resources in the short term, then you look instead at the quick ratio, where you're looking at the most highly liquid resources, so basically cash and cash equivalents, very, very near cash investments, if you can determine what the current investments are, and dividing that by the same amount current liabilities. So you can get cash and cash equivalents here, and here's an investment number, but some of those investments may be longer term investments. And so you want to look at the investment note disclosure, and what you might want to do if they're presenting a maturity schedule like this, where the fair value of the investments is disaggregated by the number of years of maturity when these investments are expected to pay off, you might only want to include the portion for the investments that are expected to mature in less than a year. Now, in fact, the government may be able to cash in any of these investments, even those that aren't expected to mature for more than a year from now. So you don't absolutely have to do this, but it certainly gives you a tighter, more conservative number if you do include just the maturities of less than a year. Heck, if you could tell which ones were going to mature in the next few months, that would be an even more relevant number to looking at the quick ratio. But you could use the total investment amount because you know that they could probably sell them, but you might want to look into whether there in fact are any limitations on their ability to cash in any of these investments. It might even, some of those limitations might even affect investments with maturities of less than a year. So using the information from the government-wide statement of net position, this is what the ratio looks like, and it comes out to 2.3, which again is a pretty healthy number. When I was first learning financial analysis, I was told that good rules of thumb for the current ratio was 2.0 and the quick ratio 1.0. Take them with a grain of salt. I'm not a big fan of those types of rules of thumb. I would much rather compare this government over time and see how that 2.3 compares with where it was last year and 5 years ago, and also compare it to other similar governments and see what their ratios are like, and use that as the basis of my judgment as to whether it's healthy or not, rather than just using some universal rule of thumb that may or may not be relevant to the particular government that I'm interested in. The third of those liquidity ratios is days cash on hand. So basically, how much cash do we have and how long is it going to last us? The ratio is cash divided by total expenses less non-cash expenses times 365. So one of the non-cash expenses is, you need the interest number, which for the governmental activities you can get from the expenses column. Interest on long-term debt is almost always shown as its own expense item. And then for the non-cash expense items, you need to go look at the capital assets note, where you're going to find the total depreciation expense for the year, and that's the amount you're going to need to subtract from total expenses. And the result, if you multiply it by 365, is 52. So you've got a little less than 2 months worth of cash on hand to operate the government with. Now, as we've seen in looking at this government-wide information, we can do both long-term and short-term analysis of financial position. Another way that you can look at short-term financial position would be to look at information in the governmental funds. Clearly, you could only be looking at governmental activities without the internal service funds, so it narrows the scope of what you can look at. You can't use this information to look at the business-type activities, obviously. But it's an alternative, and it's one that a lot of analysts tend to turn to for getting a sense of short-term financial health. So in looking at the governmental funds balance sheet, This is your fund balance section, and you know that all this detail may be on the face, or you may find it in the notes to the financial statements instead. Like net position, you've got a lot of options for how you analyze fund balance. You could look at total governmental funds. You could look at just the general fund. You could look at what you might call the operating funds, meaning the general fund plus special revenue funds. And then for any of those columns, you have a lot of options as to what part of fund balance you're going to look at. You don't have to just look at total fund balance. You could look at just unassigned fund balance. So these are the only resources that are completely unspoken for in the governmental funds. Or you might look at assigned and unassigned, because you know that assignments of fund balance can be undone without taking any further action. So those resources might be available for purposes other than the funds in which they appear. Maybe you want to look at unrestricted, much in the same way you might look at unrestricted net position, or what some people might call spendable, restricted plus unrestricted. Although you do need to be careful, because there may be some things in restricted that are in fact non-spendable items, and they're there because when they are sold or otherwise liquidated, the proceeds that are received by the government are restricted to being used for a particular purpose. So once they've been converted to spendable resources, they will in fact be spendable, but at the moment they may not be. Like the disclosure of the portion of receivables that is not expected to be collected within 1 year, the disclosure of interfund balances, meaning amounts that are owed from one fund to another, also will disclose whether there are any balances, any parts of those interfund balances that are not expected to be paid in full within the next year. So here's what a typical interfund balances note might look like, and you can see that they're showing, for each of the major funds and non-major funds in the aggregate, for internal service funds, if there were amounts due to or due from the enterprise funds, they'd be in here as well, and how much each one owes to the others, whereas you might just see a single line for amounts due to other funds or due from other funds in the financial statement itself. And then there is this disclosure here that talks about how this amount that is due from the internal service fund to the general fund of $8.8 million, that almost 7.3 of it is not scheduled to be collected in the subsequent year. So you might want to, in using calculating ratios, using fund balance information in the governmental funds, to make sure that you've removed that portion of the due from other funds if you're looking at the general fund, because you know that it's not going to be available to pay short-term liabilities. So, looking at some of the ratios that you might calculate using governmental fund information, there are three main ones that we'll look at: fund balance divided by revenues and expenditures, and assets divided by liabilities. So let's do it for all quote-unquote spendable fund balance in the general fund. So we're including restricted, committed, assigned, and unassigned. And then we're going to need total revenues. And I like to also include transfers in, because those are resources that are being used to finance the spending of the fund. So I will include those as well. So this ratio, total fund balance minus the non-spendable fund balance, that's the quickest way to get to it, usually, rather than adding up all the individual pieces, divided by revenues and transfers in. And that comes out to 0.79%. That's very small, obviously. Less than 1%. Fund balance is equal to less than 1% of the total revenues of the general fund. You might, in the denominator, use expenditures and transfers out instead. And if you calculate that, the ratio you get is equally small. 0.75%, so 0.75%. That's not what I would consider to be a robust ratio. You can multiply it by 365 to get a sense of how many days worth of resources they have, and you can see they've got fewer than 3 days worth of resources based upon the amount of fund balance in the general fund. Assets divided by liabilities. Again, since you know that there may be some non-current assets in there, you may want to take those out. Especially if you're doing assets plus due from other funds, if that's listed separately, or if that's a part of total assets, and there's a portion of that due from other funds that is not current, you may want to remove it. This is similar to a current ratio because ideally these assets and liabilities are all current assets and current liabilities, but you do know that there are some assets that in fact are not current or that aren't financial, so they're not in spendable form. So it's not an exact match for a current ratio, but it gets at the same idea that what current resources are on hand to deal with the most pressing of the liabilities. And here, this is the issue that I just alluded to. You may want to make sure that you remove the non-spendable assets from the numerator to get a more accurate picture of what's going to be available. And what I simply did was took the numbers that were in fund balance for non-spendable and subtracted those from total assets, and so you get a number that's a little bit lower, 2.4. Switching back to looking at sort of longer term issues, the issue of solvency has to do with whether a government's going to have sufficient resources at its disposal to make payments on its long-term obligations or to otherwise satisfy its long-term obligations. And there are two basic ways of looking at solvency: leverage and coverage. Leverage is the degree to which a government's assets have been financed through borrowing. And that's a broader understanding of borrowing, not just issuing of bonds, but purchasing things on account is a form of borrowing as well. So accounts payable would be considered a method of financing the acquisition of assets through borrowing. There are two primary ratios that we use for measuring leverage: the liability to assets ratio and the liabilities to net position ratio. So liabilities to assets ratio is total liabilities divided by total assets, and you can get those numbers very easily from the statement, the government-wide statement of net position. And so looking at that for governmental activities, your ratio is almost 90%, 89.77%. What that means is that for every dollar of assets the government has, it's got 90 cents in liabilities. So it's going to require most of the assets it has available in order to satisfy those liabilities if they all had to be satisfied right now. Of course, they don't have to all be satisfied, but what we're trying to get a sense here is, of the government's, leeway here. Does it have more assets than it has liabilities? The other thing that you would look at for these leverage ratios, in the denominator instead of total assets, is total net position, and also looking at the governmental activities, that ratio is 615.33%. So that's a stunningly high number because you're taking into account all of the net position available to the government, all the resources at its disposal to operate and to finance the provision of service and to satisfy their liabilities, and the amount of liabilities they have is 7 times greater than the amount of that resources, and that's because in these governmental activities they have that gigantic negative unrestricted net position. Looking at the same ratios for the business type activities, instead, you come up with a ratio of 62%. So for every dollar of assets for of the business type activities, those activities owe 62 cents. That's still a pretty high level of leverage, but not nearly as much as the governmental activities. And then looking for the business type activities, total liabilities divided by total net position, and that's certainly a healthier looking number. The amount of liabilities aren't nearly as overwhelming in comparison to total net position, but there are still more liabilities than there is net position, associated with those activities. One of the things you need to keep in mind anytime you're using total net position, because it includes net investment in capital assets, which is the net book value of the capital assets minus the debt issued to or incurred to finance those particular capital assets, that some governments use the modified approach to report capital assets, to report some of their infrastructure assets, and so they're not depreciating those capital assets. So it may have the effect of making their net investment in capital assets look more robust than another government that isn't identical in all ways, except it just uses depreciation for all of its infrastructure assets and it doesn't use the modified approach. Consequently, if you're using a ratio with total net position in it and comparing those two governments, it might make the government doing the modified approach look like it's healthier because of the way it is reporting its capital assets. So, let's look at some governments that it would just a sample. Looking at this government that uses the modified approach. Comparing its liabilities to its net position, you come out with a ratio of 0.93. But if we were to, estimate what the depreciation might have been on the infrastructure for those capital assets, and adjust for that, then, it doesn't look nearly as healthy. The first ratio, 0.93, means its net position exceeds its liabilities, and that, all things being equal, you'd kind of like that. You'd like this ratio to be as low as possible. And if you undo the effect of reporting infrastructure using the modified approach for this particular government, it shoots that ratio way up. Now, the liabilities are more than 1.4 times what that government has available in net position. Now, this is something that you obviously need to pay attention to, particularly if you're comparing states, because either 23 or 24 of the states use the modified approach to report some of their infrastructure assets. Primarily, they're reporting highway and assets and bridges. So there are some clear comparability problems there if you're analyzing states. A lot fewer non-state governments use it. Depending upon who you ask, it might be somewhere between 5 and 10% of local governments use it. So you're a lot less likely to run into it, but you do need to pay attention to it and be aware of it if the government you're looking at uses it, or if some of the governments in the comparison group for that government of interest use the modified approach. It may affect the comparability of the information. I think that probably argues that if you're building a peer group to compare your government to, that you probably shouldn't include governments that don't use the modified that use the modified approach if the government you're looking at doesn't use it, or vice versa. If it is a government that uses it, you might want to make sure that the comparison governments all use the modified approach as well. This is something that I believe will wash out over time because if governments that are using traditional depreciation, as they spend on those infrastructure assets in order to keep their useful lives, to extend them, to keep them going to preserve the service capacity at a constant level, those are expenditures that they can capitalize, that they can report as new capital assets to add on to their total historical cost for their capital assets. So they will be adding value to those capital assets over time, whereas a government that's using the modified approach, that historical cost is going to stay flat because they're not depreciating it, and the spending on those assets that might otherwise have been capitalizable, they're actually reporting as expenses instead of reporting depreciation. When that's going to balance itself out, I have no idea. It's obviously already in process since these standards have been fully in effect for more than a decade, but I suspect it'll take a longer amount of time. So for the time being, you just need to be aware of the possibility that you may be making comparisons between governments that do and do not use the modified approach. And here's an example of how this might be working out. So you can see, this one government, is reporting, it's got a $5 million capital asset, and it's reporting the preservation expense of $100,000 that it spends every year. So the reported amount of the asset hasn't changed, but for the government that is depreciating the asset, the net book value of that asset is being reduced by $100,000 a year, so that would bring it down to $4,500,000. However, those preservation expenses for the first government over here, would be capitalizable for this other government that's just using traditional depreciation. So that would add to their capital assets. So they still both end up in the same place. And ultimately, it may be that these governments that are using regular depreciation and adding new assets to their capital assets as they do preservation expenses, preservation spending, may in fact end up ultimately having the higher book value for their capital assets, and therefore the higher net position. So the other solvency measure other than leverage is coverage, and that's looking at whether the government is going to have enough resources when it needs to make payments on its long-term obligations, primarily looking at long-term outstanding debt. The two primary ratios for measuring coverage are times interest earned and debt service coverage. And one of the problems you have here is that although this is simple to do for the business type activities by looking at information in the proprietary fund financial statements for the enterprise funds, for the governmental activities and their debt, you can't do it because there is no cash flows information for the governmental activities, either at the government-wide level or in the governmental funds. So looking at the first of these two ratios, the times interest earned ratio, it's cash flows from operations plus interest expense divided by interest expense. So looking at the proprietary fund cash flow statement, we'll do this for total enterprise funds, but you could certainly do it for either of the individual enterprise funds here, either water and sewer or parking facilities. This is your net cash provided by operating activities, so that's your operating cash flow. You can get interest expense from the non-operating expense section of the Statement of Revenues, Expenses, and Changes in Fund Net Position for the proprietary funds, and that gives you a ratio of 1.69. So there, these inflows that are available to make interest payments are equal to almost 1.7 times the amount of those interest payments. Is that good? Is it bad? How do you know? You compare this government, track it over time to see what direction it's heading, compare it with its peers to see whether it's higher or lower than the ratios that they have. Debt service coverage is looking at total debt payments, so not just interest, but also the principal repayments as well. One place where you might find the amount of the principal payment for the business type activities or for the enterprise funds is by looking in the changes in long-term liability note, and the amount of the reduction during the year for bonds and notes payable is probably the principal amount. Where this gets a little complicated is if the government has done a bond refunding during the year, because the proceeds of the refunding bonds are going to show up in the additions, and the retirement or the defeasement of the refunded bonds is going to show up in reductions. And really, when you're doing this, you only want to look at the current period debt service payments, the current period principal. So it may not be as straightforward as you'd like it to be. You may, in fact, need to inquire of the government about what its principal payments were for its business type activities. That ratio is almost 1.38 for the business type activities. You expect it to be lower than the times interest earned number, because you're looking at the sufficiency of making not only the interest payments but also the principal payments as well. Now, I want to wrap up by talking about a couple of practical things that you need to be mindful of when you're doing trend analysis for a particular government. So if you're looking at ratios that use net position over an extended period of time, you need to be aware that as of about 5 years or so ago, governments were reporting the residual as net assets rather than net position prior to the reporting of deferred inflows and deferred outflows of resources. It resulted in a change in the name of the first component from invested in capital assets net of related debt to net investment in capital assets. But the good news is these three components are still defined exactly the way they were defined before. And so even though the name has changed, and you should be aware of that, the measure of this financial position amount remained the same over that entire period. And so you should feel fairly confident in looking at net position amounts that they're comparable with the net asset amounts that were reported previously. The same cannot be said for fund balance. Looking back to approximately 2011 or so, when GASB Statement 54 was implemented. Prior to that, governments were reporting fund balance in reserved and unreserved components, and they optionally could break unreserved fund balance into designated and undesignated. Since implementing Statement 54, they now report 5 categories of fund balance, and there is no way to easily crosswalk the new categories with the old categories for 2 reasons. One is that by definition they don't happen to line up directly, and secondly, part of the reason why we have these new classifications of fund balance is that the old classifications were poorly applied across the board by governments. There was a very large proportion of governments that were making mistakes routinely in how they determined whether fund balance was reserved or unreserved. And so a lot of the numbers prior to the implementation of Statement 54 may in fact be inaccurate, with things being reported as reserved that should have been unreserved, or vice versa. So you really can't do a trend analysis with the fund balance information. At least now we have, for most governments, at least 4, maybe 5 years of the new fund balance information, and that's a decent trend. I think if you ask any bond analysts, they'll tell you they want 3 to 5 years, and they generally don't look at a longer period than that. So we've probably got enough years where you can do that analysis just looking at the new fund balance classifications. And that's the end of the lecture for Unit 3. I look forward to the discussion with you in the course website, and this topic is the subject of the first assignment for the course. If you have any questions about that, please do make a point of asking me. I also want to let you know that I have posted to the website an Excel file that shows how each of these ratios that I showed you in the slides is calculated, so you can look at the formula in the Excel file, and that will help you to understand how the calculations were done, and perhaps to replicate those when you do assignment number one.